Hello, I'm Elliot Hirschman. Welcome to another chapter in our series of 6-minute seminars. Today's topic is retirement plans for businesses.
Simple IRAs. A simple IRA plan, savings incentive match plan for employees, is a written salary reduction arrangement under which eligible employees can elect to have the employer contribute to their simple IRAs rather than receiving that amount in cash. Under the plan, employees can elect to defer a portion of their compensation, and employers are required to either match the deferral or make a contribution on behalf of each employee, all subject to limits. The following table explains a simple IRA plan quick facts. Contributions to a simple IRA. Contributions are made up of employees' elective deferral contributions and employer contributions. The employer must make either matching contributions or non-elective contributions. The amount the employee chooses to have the employer withhold from compensation and contribute to a simple IRA on his behalf cannot be more than $12,500 for 2016. Participants age 50 or older can make catch-up contributions up to $3,000. SEP plans. A simplified employee pension, or SEP plan, is a written arrangement that allows an employer to make contributions to IRAs established by or on behalf of each qualifying employee. Subject to limitations, contributions to a SEP are deductible by the employer and excluded from the employee's income until withdrawn. In addition, federal income tax on the employee's account earnings is deferred until distributed. Employer advantages of a SEP. Contributions to a SEP are tax deductible, and the employer pays no taxes on the SEP's account earnings. The employer decides each year whether and how much to contribute to its employees' SEP IRAs. Generally, the employer does not have to file any documents with the government. The employer may be eligible for a tax credit of up to $500 per year for each of the first 3 years for the cost of starting the plan. Administrative costs are low. Funding a SEP plan. For 2016, contributions are excludable from the employee's income to the extent they do not exceed the lesser of $53,000 or 25% of employee compensation up to $265,000. Contributions to a SEP must be immediately 100% vested, made pursuant to a written allocation formula, non-discriminatory. If the plan is top-heavy, certain minimum contributions must be made. 401k plans. A 401k plan is a type of profit sharing or stock bonus plan to which participants can choose to have part of their compensation distributed on a pre-tax basis instead of receiving the compensation in cash. This contribution is called an elective deferral because participants elect to set aside the money, and they defer the tax on the money, along with investment gains or losses, until it is distributed to them. When the 401k plan is part of a profit-sharing plan, employers have flexibility in making discretionary contributions. Employee contributions. Employees cannot defer more than the annual limit that applies for a particular year, $18,000 for 2016. A 401k plan can permit participants who are age 50 or older at the end of the calendar year to also make catch-up contributions, $6,000 for 2016. Employer contributions. 401k plans permit the employer to contribute and deduct up to 25% of total participant compensation, up to $18,000 for 2016, to the plan. To encourage participation, employers can offer to match salary deferrals under a formula stated in the plan. The employer can also set a cap on the maximum amount they will match. Safe Harbor 401k plans. Safe Harbor 401k plans allow an employer to make certain contributions to a 401k plan as an alternative way of meeting the non-discrimination requirements. Contributions may be made under a Safe Harbor 401k plan using any of the following methods: non-elective contributions of at least 3% of compensation, basic matching, enhanced matching. Non-discrimination rules. A 401k plan must provide substantive benefit for all employees, not just business owners and managers. These requirements are called non-discrimination rules. An important aspect of performing non-discrimination tests is to identify the highly compensated employees, or HCE. The tests compare contributions for the HCEs and other employees and show if the employer must make additional contributions to benefit lower paid employees, NHCEs. One-person 401k plans. When self-employed individuals establish a 401k plan, they are both the employee and the employer, so they deduct both the elective deferral and the employer contribution. Thus, a one-person 401k plan often maximizes a self-employed person's deductible retirement plan contribution compared to a simple or SEP plan. A 401k plan also permits a larger contribution than regular profit-sharing plan when compensation is below $265,000 in 2016, or when the taxpayer is 50 or older by year end. If other employees are hired, 401k contributions may be required for them. However, it is permissible to exclude from coverage any employee who is either under age 21 or has not completed 1 year of service. Participant loans. Many 401k plans permit loans to plan participants. A loan to a participant must meet a number of rules under Section 72P to prevent the law from treating it as a taxable distribution to the participant. In general, the amount of the loan cannot exceed the lesser of 50% of the participant's vested account balance, or $50,000.
Thank you for your interest. If you have any questions, feel free to give me a call.